Blair Hull. You launched the Hull Tactical US ETF in June, and it's been slightly up. We're essentially flat since then versus a 2% rise in the S&P, but it's been a wild ride in the S&P. So talk about the tactics in your tactical ETF.
Well, we were very disappointed with our returns in 2008, and I was determined to get a systematic and disciplined approach of addressing the problem of the market. And so what we did is we built a model based on all the academic literature that we could find, and we came up with a strategy that over the long run we believe will outperform the market. It'll actually give you less volatility than the market, but we hope it'll outperform.
It'll also give you, I guess, less returns compared to the S&P, because over the past month, the S&P is up around 6%, and you guys are up around 60 basis points. So can you dig into your model a little bit? What do people actually own in this ETF?
Well, you own either SPDRs or cash. And what the equity risk premium is, how much do you get paid to assume equity risk? And so we believe that there are certain times that you ought to be more exposed to equities and less exposed. This is a long-term strategy that we believe will perform over a market cycle. So you can't really judge the performance over a short period of time.
But are you trying to beat the S&P over that long period? So just talk a little bit about the expectations for this fund, because once again, if you've been in it for the past month or even since June, you'd be disappointed.
Well, it's hard to say whether you'd be disappointed because we've had much less volatility. So if you take a look at things on a risk-return basis, we are very confident that we'll beat it on a risk-return basis. We also think that we will beat the absolute return of the S&P.
So how much of this product should an individual investor have in their portfolio? Is it a hedge to the rest of their funds, or should they go all in, 20, 25%?
Actually, our family office has had 10% of our assets allocated to this strategy over the last 3 years. Now, you might ask the question, why don't we have more allocated to it? Well, as in all investment strategy, you need to diversify. And this model that we've developed, which will eventually become a combination of models, we have found that in predictive analytics, which now is part of our lives everywhere, whether it's credit screening, whether it's predicting the weather, whether it's a Google driving their car, predictive analytics are everywhere. But because of the stigma of market timing, people don't use it relative to the market. And I believe that just as in the last 30 years, where it was considered irresponsible to be participating in market timing, I believe in the next 30 years it'll be irresponsible not to participate in market timing.
And then finally, your fund can go 200% long, I think, and 100% short. A lot of people get scared when they hear of leverage involved with anything. So just talk about the safety of this fund, because some people will get unnerved when they see that.
Well, the issue is, can you take the position when the odds favor you? How big a position should you take? And the issue is that right now in the marketplace, we don't see a big upside to the market. And that's why we're only 30% invested. But at certain times, it may be advisable to take a larger position. But overall, the product is designed to have less volatility than the S&P 500.
So what will it take for you to see more upside in the market? What's the catalyst? What will trigger you to go further long or further short?
It's a multi-factor model that changes. We build it every 20 days, and we use it for the next 20 days in a systematic and disciplined way. One of the issues with market timing is that their emotions get involved. We don't have emotions. We have a model.
And what's in the model?
Tells us exactly what.
What's in the model? What are you factoring in?
We have a paper out on the Social Science Research Network, which will be published next year. And that describes 20 indicators that were in the academic literature and how we go through and use those indicators. We're very transparent about this. And in fact, on the website, there's a way to describe how to replicate the paper.
Okay, indicators like?
There's an interesting indicator called K, consumption, assets, and income. If you have it's actually wealth and income predict how much you should consume, how much the economy consume. If we're consuming and spending more money, the market tends to rise. If we're spending less money, which we are doing right now, than what would be predicted by wealth and income, then the market tends to go down.
All right, well, thanks a lot, Blair.
Thank you. Good to be here.
And thank you for watching The Street.